Good morning, everyone. I'll start from this podium, and then I'll join the team sitting down for the questions. I'm Carmelo Cucuzza from European Investment Bank, and I thought I should start with a very brief introduction about the infrastructure investments that European Investment Bank does. Because for those of you who are not familiar with the bank, we were set up essentially back in 1958 for the establishment of infrastructure in Europe. And that was our original mandate. Out of the 77 billion euro we provided last year, only about 10% went outside of Europe. So as you can see, the mandate for European Investment Bank is essentially to cover European infrastructure, and obviously being governed by the 28 member states of the European Union, we are also being allowed to extend the mandate to outside of Europe. So we do also work with African countries. We have regional representations here in South Africa, in Kenya for East Africa, in Senegal for West Africa, and we're about to open another one in Yaoundé for Central Africa. So given the topic is to mobilize institutional investors for infrastructure, I think it's very, very relevant to also our participation when we look at the financing of infrastructure projects in the African region. If I start looking at the overall investment climate as it is now, for the DFIs, in terms of attracting also institutional investors, we are seeing World Bank, EIB, African Development Bank, PDA Bank also as those catalysts that help lure infrastructure investment into Africa. What the challenges, however, that we do face are quite substantial, because it's not a matter of finding a number of projects. The projects are all there. We all have pre-feasibility studies. It's also to find the bankable ones. And we all know that it takes a very long time to develop projects to the bankable stage. And sometimes it can take even longer, especially when there is government interference, or when there's government need to have put a regulatory framework in place. And actually that brings me to the challenges that some of us DFIs are facing, which also are very directly linked to what the institutional investors are facing. There are basically 5 challenges that we have in order to find bankable projects. Number one is the investment climate and the environmental and the institutional framework, the regulatory framework, which is often not in place when we do come to some of the countries. We do have good developers who come into the country, they find a good project, there's a feasibility study has been prepared, yet the regulatory framework is not there. And what happens, invariably we need to collect legal assistance, technical assistance, and provide that kind of helping them to set up the regulatory environment. That can take even years to set up, and that obviously delays the bankability of the project. Secondly, as some of members of the local electricity company, ESCOM, have said, it's not just about CapEx, it's also about human capital. You can build it as much as you want, but if you don't find people to run it, then it won't work. And what we found invariably is that the CapEx is there, I mean, the financiers are there, but actually getting the human people to run some of these entities is quite challenging, without, of course, having to incur the costs of having to get consultants to be brought in from the first world. And of course, they need to develop the human capacity here in Africa in order to be able to run and sustain some of these investments. Another big delaying force is the fact that there's a lot of talk of regional integration, but the regional integration is really taking much longer than we anticipated. We look at SADC here in Southern Africa, we look at the East African Community, we look at COMESA. All of them are very good initiatives, but invariably we find that it takes time, especially for some of these interregional projects to be developed, because it takes long to get the agreements, the various agreements between the governments in place and having them on board. So that the slow processes that need to be accelerated if we also want to accelerate interregional infrastructure investment. Another issue perhaps is the transparency and governance that govern some of these projects. Sometimes questionable tenders are being given and directly agreed with the developers without international tender. That makes it difficult for us as a DFI to be able to provide funding for such projects because of the nature of our funds, which are public funds. So it's very difficult for us not to justify an international tender or having to find that the government has already agreed with a developer on how to set up a project. And hence, we cannot intervene and we cannot provide the financing. I mentioned the slow capital. The other one is, unfortunately, in some of these economies in Africa, we find that the financial markets are inadequate for some of the more general complex structured projects with SPVs and joint ventures. And therefore, perhaps do like bond issues and raising money on the market can be more challenging and even more expensive because you don't have the inadequate financial structures in place. So all of these combined make it challenging for not just for the DFIs, but also for institutional investors to come in and being able to provide fresh capital to support infrastructure projects. And having said that, then I will join my panel, and maybe I can start directly with Terence. We'll ask the panel to introduce themselves, and Terence, and just a quick word about your organization, Nedbank, and then pass on to the rest of the panel for an introduction.
Good morning. So one of the key challenges is obviously energy, and this thing has run out of energy. So you will hear energy spoken about a lot, and I hope this thing is listening. Good morning, my name is Terence Spear. I'm with Nedbank, Nedbank Corporate Investment Banking. I look after what's called client coverage, which encompasses a lot of the investment banking product, as well as the corporate bank and the big client, key client relationships of the bank. In that mix, obviously, then, are clients that are largely based in South Africa or clients that are also doing a lot of investment on the rest of the African continent. So my perspective this morning will be mostly from the banking lens as an institution, as a financial institution. And in conjunction, then, we also do work with other financial institutions, which my colleagues and indeed the floor represent.
Good morning. This is a great example of a development agency and a bank working together, sharing the mic here. So very briefly, I lead a group within the U.S. Agency for International Development called the Africa Private Capital Group. Briefly, we have three main focuses with an overall mandate to unlock commercially driven private sector capital into development-related transactions. The first area of concentration is transactions, so working with investors directly on transactions to find what the gaps are and what we can do as an sub-Saharan Africa-wide to facilitate those transactions. The second area of focus is municipal finance, how we can work to create access to capital for those municipalities that are trying to meet the burdens of urbanization through bond issuances or straight debt. And then lastly, and most relevant to this panel and to this group of people here, is we've created a partnership with the Department for International Development, or DFID, through the UK, on trying to unlock South African pension fund capital to the rest of the region. And I think that we can discuss that a little bit more later in the panel, but it's very clear that with $320 billion under management, thereabouts, and regulation that allows for 5% over the 25% cap to the sub-Saharan Africa region, it's a great opportunity if we can all partner together to move the needle a little bit. Would be a huge development impact.
Good morning. My name is Mark Mandaba. I'm heading the Timmies Energy, which is the project development company of Abraj Group. Abraj is a $10 billion equity platform specialized in emerging markets, Latin America, Africa, Middle East, and South Asia. Out of this $10 billion, around 1/3 is raised from institutional investors. And this is definitely a pocket we want to tap in and raise more capital. So we have some experience, and as much as at the moment there is a slowdown in the Western economies, it's still a bit challenging to attract institutional investors in this region for this type of asset. So we'll discuss this after. Thank you.
Adamasu Tadessa is my name. I run PDA Bank. PDA Bank is a development finance institution, as you've heard our colleague from EIB mention. We're a little bit different from many of the others in that we're what we call a third generation DFI. We're set up in the 80s. We're very commercially orientated. We were set up to actually be different from some of the others. Very similar to IFC and Afri-Exim. We do a combination of trade finance and infrastructure development finance, as well as SME finance. And we do mostly debt, but we do a little bit of equity as well. Our geographic scope is Eastern and Southern Africa, but it's the expanded scope of Eastern Africa, which means also Egypt and Ethiopia, as well as the East African community. And we go all the way down to Zimbabwe, Mozambique, Mauritius, and so on. We are a hybrid. We're led by public sector shareholding, but we also have private sector shareholding. And that's one of the innovations we've introduced recently. So when we talk about mobilization of private capital, we are an embodiment of that. We're one of the very few multilaterals that's actually a public-private partnership in the sense that we have a mix of shareholding. We pay dividends, and we have market-orientated shareholding structures as well.
Good morning. My name is Nigel Drew. I am a project finance partner at the international law firm DLA Piper. I head the energy and infrastructure finance team in London, and about 80%, I would say, of our work is on projects, either power projects or oil and gas projects around Africa, which is just the way in which the market is working at the moment. Thank you.
Okay, so maybe I can start with a round of questions. And I'll start with you, Terence. Given that you're with Nedbank, and Nedbank is regularly in the market, both seeking and arranging transactions, how would you characterize the infrastructure investment climate for long-term institutional investors seeking to enter this asset class?
Thank you. I think from the perspective of Nedbank, maybe it'd be useful to also give some context, because I also don't sit here just on behalf of Nedbank, but many of you will know that we have an alliance with EcoBank, and together with EcoBank, our coverage of the continent then spans 39 countries. And the reason I say that is because our pipeline, therefore, is quite strong, and it'll give us some kind of framework against which we can answer your question in terms of what we see out there, the project's landscape in particular. From a bank's point of view, I think what we're seeing is that institutions, particularly those institutions characterized by pension funds, asset managers, some hedge funds, chasing longer-term yield, are still having a lot of appetite, and in particular because the deals, as you mentioned in your opening remarks, tend to be longer dated and tend to be quite protracted. And so some of the investment criteria that guides, or the mandates that guides institutions, asset managers and pension funds in particular, tend to look for that longer dated leg of these projects, or longer dated funding of these projects, wherein banks, mine included, would typically participate in the shorter end of the project, or shorter end of the funding of the project and price it accordingly. So we are typically seeing projects being structured along PPP lines where institutions chasing yield and chasing yields on behalf of their underlying funds on the longer dated end, and banks playing in the shorter end. Having applied a few filters in the past 6 to 8 months of the live projects or summary of the projects that we see per sector, from a bank's point of view, what we're seeing is that transport is still largely dominating. In 13 countries that we analyzed in a report that we have compiled, we found that in particular transport, followed by power, mining, some projects still in social and defense sector. Oil and gas, for obvious reasons, seems to have tapered off given the volatility in the oil price. And then we're seeing the emergence of a new class of potential investment opportunity in the water sector. So we're coming across a few desalination plants, we're coming across a few water purification projects, which many are state-driven or public-private partnerships, but largely against the backdrop of state guarantees or state, including DFIs, as well as local funding institutions being packaged in that particular way. From the bank's point of view, that is the investment client we're seeing. You have already touched upon what would typically attract the bank is a solid investment climate, in particular the regulatory framework, and particular to banks with the emergence of Basel III and its implications, or application and implications incumbent upon banks globally. We're finding that it's becoming a little bit expensive to price some of the projects, given the fact that we have much higher net stable funding ratio, liquidity capital ratio requirements upon us, and indeed a heck of a lot of governance around also how money moves in terms of anti-money laundering has made it a little bit more difficult, or it's made it a little bit tougher, and therefore a little bit pricier for the banks to participate in some of these projects. I think in summary, that's what we're seeing in terms of the climate, in terms of the project landscape. Still very big appetite, but the pricing of the deals has definitely changed upward with some upward pricing pressure.
Thanks very much, Terence. And maybe we can move to Chris. And you mentioned, Chris, the fact that obviously you're dealing with institutional investors. I was just wondering how, given that your focus has essentially been to paint the opportunity set for the investment in infrastructure in Africa, how do you normally pitch to those institutional investors, and how do you present to investors a possible infrastructure pipeline as a vehicle for investors to invest in?
Sure, thanks. I think again, another great example of coordination and cooperation. I think the key to that question actually is not that we want to pitch. As a development agency, and it's quite difficult for me, coming from an investment banking and hedge fund background, it's not our job to pitch or advocate or say, this is where you should be or this is what you should do. We have to have respect for the investment community, especially the pension funds, that they have a mandate and a responsibility to invest responsibly for their future pensioners. So the principle for our objectives is to align our interests, to say these are commercial interests to you and these are development interests to us. And getting there is in fact the challenge. What we are hearing from the pension funds and what we've, in our conversations, what we've heard is there's a risk threshold. As Terence mentioned, there's just higher risk when they look out into the continent, and unfamiliarity. Currency is a big issue. A lack of familiarity with private equity and how private equity would look if you're going off the exchanges. The cost of transactions actually pre-close, which may fall into project preparation. There's a lot of conversation yesterday about project preparation and getting these potential investments to investment ready. One very specific conversation with a trustee at a major pension fund mentioned that the cost of a $50 million deal that was going to happen on the continent required about $200,000 worth of legal fees prior to the investment. And those legal fees, that $200,000 ticket, was too high, too much money for that $50 million deal. Now, coming from my background, you would spend that $200,000 several times to get to that $50 million deal. So that was something that we heard that we found was kind of surprising. Getting into now, how do we address those as a development agency? One of our biggest tools is a loan guarantee. So we can do a 50% partial guarantee for a commercial lender. Just walking through an example, in Dakar, we partnered with the Gates Foundation and the World Bank to do a guarantee for a municipal bond. Ultimately, the Gates Foundation did all of the technical capacity to get the city into a place where they were able to issue and service debt through a bond. The USAID gave a 50% guarantee, and the World Bank arranged the credit score and the credit rating. The bond is fully subscribed. Institutional investors were on board. Unfortunately, at the final hour, the national government took away the authority of the city to issue debt, which was a surprise, and so we'll call this deal sort of on life support. But that brings up to the regulatory framework, which is an ongoing issue. So there's layers and layers and layers. And the idea behind our approach is to sort of peel back each layer, but peel it back with the potential investor. The other thing that we've heard is co-investment. So institutional investors in South Africa and institutional investors in America are interested in infrastructure and projects in the region, but they would be more comfortable if a local pension fund or there were local investors on board. So facilitating that is of interest to us too, and to find out that good mix. And lastly, and I mentioned this briefly, but project preparation, getting them to that investment status. We are working closely with a major entity right now to build a for-profit commercial project preparation facility. So that's sort of an overview of what we've heard, what we're hearing, and the ways we're trying to approach it. But if you take away anything, really what I said at the beginning is the most important. As a development agency, we aren't trying to pitch or advocate or push money in any direction. We're trying to align with the pension funds that are trying to diversify their asset allocation, that are looking at the timing of these potential infrastructure investments as in sync with their needs for long-term investment, and finding ways that as a development agency with a presence in the majority of countries in Africa, what our existing activities and programs and opportunities to facilitate those are.
Okay, thanks very much, Chris. If I can move down to Mark. Mark, Abrash Group, obviously as a developer, you have a unique opportunity of seeing a lot of investment-grade infrastructure projects, pipeline across various sectors. Can you highlight a profile of those projects, and which do you think will be investor-ready, particularly with regards to the best options investors would have to participate in these deals?
Thank you. So, if we take just one step back to see where Abrash is coming from. So it's a large PE platform present for more than 15 years in Africa. They raise funds, etc. And they have, as I said before, 1/3 of institutional money. However, when they decided last year to launch a new energy platform, it is because these energy assets in emerging markets fit very well institutional investors' appetite. So if we just summarize, I mean, energy projects are public goods based on demography, economic growth, with what we call the impact, which we used to call development projects for the last few decades in the continent. You have long-term predictable cash flow. You have contractual cash flow. You have no market risk in Africa usually because you don't have wholesale markets. You have inflation protected or adjusted return or cash flow, structured finance, and you even have some foreign exchange protection. In our PPAs, most of the time, you have a protection against US dollar or euro, except in a large market like South Africa, where you have a local base of investors anyway investing with their own currency. So if you put all this together, this is the dream of any institutional investor. Any pension fund who is placing money for their pensioners, they want to have this 20 years cash flow guaranteed, contractual, etc. That's even why when we hear the word IPO for power assets, it's a bit strange, because a power plant will never become a Facebook, will never become a WhatsApp or Apple. It is something which is quite well defined and very well designed for institutional investors. And this is the way the market grew, I think, in Europe and US at the beginning. So now, what is the issue we face when we go and try to fundraise from these institutional investors? Because on the paper it looks good. Still, it's the risk perception for wrong or false reason, but this is what we are getting from the market. The political risk is the number one, always. So we have more and more political risk insurance product coming. Still, I think there is still some bandwidth limit. Trying to get a $500 million PRI is still a problem today. And it's also a bit, maybe a perception item, because we look at a Moody's study on all PPPs in all markets. We found that in OECD, default rates is around 5% of PPPs. You go in other emerging markets, Asia, Latin America, it is around 8% default rate. You come to Africa, it is 2.2% default rate. So in effect, Africa defaults 2 times less than OECD country and 4 times less than other emerging markets. Yet, people think it's risky. What is clear is that reaching financial close is more difficult in Africa, but once you reach it, project goes well. So this is the first risk, political risk and sovereign risk. The second one, I think, is construction risk. And this is really something maybe on which we need to work to get institutional investors in, because they all agree to come in projects after construction. Actually, we are establishing a new vehicle to come to invest only after construction, because what people fear is to invest in a project greenfield. There is nothing, you have construction risk, you have first year of operation risk, they're not comfortable. So now we are slicing our investment in 3 phases. Development phase, which is what I'm doing, the normal private equity phase, taking construction risk, but we are putting another vehicle, which is what we call the yield co, but with the Standard Design story, it's becoming a bit unpopular, but it's basically a vehicle which is not taking construction risk. And then I think we can make a link between our local commercial bank that can take a 4 or 5 years construction risk, and then hand over after 4 or 5 years after construction, hand over these to more institutional investors, risk averse, for long-term operational risk. So, voilà, this is basically, I think, what I wanted to say, that power project, I think, fits extremely well because of the PPA and so on, but still we have to address these 2 risks that institutional investors see, political risk and construction risk.
Thanks very much, Mark. If I can move now to Atmasu, if you can share with us your views on the infrastructure investment climate in Africa from PTA's point of view, just very quickly.
I think one way to look at this question of the investment climate is to stand back and just look at the overall reforms that have taken place in the continent. I think we've seen a journey of about 20 years go on, and we've seen the outcome of those reforms in terms of stability at the macro level. There's a huge change in the past 20 years, and we've even seen that move into the meso space. I mean, when we talk about the infrastructure-specific investment climate, all you have to do is look at telecoms to see what's been achieved. We're not it's not a pipe dream, it's real, it's happened. Now I think the question is, how does one unlock the power space, which is really the very exciting sector everybody's expecting big change in. And we've seen that sector also go through quite a bit of liberalization. We've seen several countries unbundle. We've seen a lot of PPPs come into fruition. Of course, the difficulty is there. It's not easy sailing. It's not like the telecom sector, because those are standalone merchant operations where there's little interface with state, apart from the licensing. So there are specificities to the network infrastructure. I think the whole question of creditworthiness of sponsors, of utilities, the whole issue of PPPs. Now you're really talking about reforms at the micro level. So we've seen very profound success at the macro level, including even the political level. If you look at the issue of conflict and contestation, what we were seeing in the 80s versus what we see these days. So the macro space has really come a long way. It's not perfect, but I think the real issue now is how do we get the micro environment to work? Because it's really more at the level of regulation, the legal framework, not just what's on paper, but also the practice, the people who are expected to implement those frameworks and conduct the processes that need to be managed. And I think that's where you see a lot of ongoing challenges. I think the world as a whole has put the spotlight on micro reforms. We see the tracking and the reporting going on regularly in terms of the environment of doing business. Many African countries have captivated the imagination of the world by being in the top 10 of reformers worldwide in terms of little things, administrative efficiencies, getting the red tape out, getting the bureaucracy to work better. So I think when you look at those aspects, you begin to get confidence that the investment climate actually is really changing. The problem, of course, is when you're in it, you don't have the patience, you don't want to look back too much. You want to look at the possibility and the potential to convert deals that are on your table at that point in time. And we all get frustrated. We have deals that we all have on our books. We all have risks that we need to manage, and that's where the impatience comes in. I think the next round of reforms are not, it seems it's easier to do it at the micro level compared to the macro, but the reality is probably not as it would appear, because dealing with human capital issues, which is a key part of it really, getting the institutions to work. It's not a question of political will anymore. Actually, it's about capabilities. Even the corporate sector, companies have challenges getting capabilities aligned and in place. So there's a lot more going on in the micro space than I think we've all appreciated would be as difficult. I think it's just a whole lot more harder. I think DFIs, of course, have a role to play. There have been a lot of facilities to support the upstream aspect of project development. But I think those are very good at the project level, but we still have a lot of problems in terms of interface with utilities. You know, in the end, even if it's a PPP, there's always the payments that have to come through from the sponsor. And so you have, whether it's a currency issue or whether it's a question of timely payments. Of course, there can be credit enhancement, but that piles onto the costs, and that also creates additional constraints. So I think that's the perspective on investment climate. I think in terms of platforms and strategies, I think what's very interesting is, first of all, we've seen private equity come in a big way. 10 years ago, you can count under one hand, under maybe 2-3 private equity firms. Today, you're looking at 10-15 private equity funds dealing specifically with infrastructure. Not everybody has the best things to say all the time, but you see there's activity and there's movement.
Private.
I think the very recent developments are also quite interesting, where you see multilaterals now going into that space to actually support the traction on the ground. You see the Africa 50 Fund, which is still very young. We are raising the Comesa Infrastructure Fund. Of course, the DFIs have supported the mainstream private equity funds by taking a stake in them and doing partnerships. But now you see even special purpose infrastructure funds being created within multilateral frameworks. Now that introduces a whole new space and opportunity, I think, for pension funds and others who can't seem to get over the hurdle of coming into a sub-investment grade marketplace. And so you now have inbuilt credit enhancement that comes through by having multilaterals literally owning the funds. And by a multilateral owning a fund, that means you have recourse to callable capital to the extent that the fund has that link. I mean, we've actually demonstrated that ourselves as PDA Bank by literally offering our own shares, not a special purpose fund, but actually offering the shares of the bank itself as a proxy for the infrastructure asset class. And because we're commercially orientated, we don't do concessional financing. It made sense. And we launched this new class of shares in 2013. We had intended to raise about $100 million over 5 years. We raised it in about 2.5 years. And we've been paying dividends on that. And it's actually interesting because you can actually give diversification benefits as well. You can offer geographic diversity. You can also offer some element of sectoral diversity. You can even offer instrument diversity in the sense that there's a blend of not just equity, but you have mezzanine. You can even have senior debt. So you have a whole lot of blending going on in a very unusual way. And we found quite a few pension funds have found that quite attractive. And attractive because also you're able to give that annuity income. So, you know, you get capital appreciation on the shares themselves, but then on top of that, you get the annual yield, which, we've been delivering about close to 4% yield in 2014 and in 2015. That's over and above the capital appreciation of 10, 11%. So an overall ROE of 14, 15%, where a good third of it comes as a yield, the remaining 2/3 is capital appreciation. That has actually got us quite a bit of traction. In fact, that story has been a lot easier for us than raising some of the funds, because the whole, waiting 10, 12 years, and that's got its own set of risk digestion that needs to happen at the level. I think I'll stop here, in the Q&A we can add more.
Thanks very much, Anna. So I think there will definitely be questions about your fund coming up in the Q&A session. But let me just move very quickly to Nigel. Nigel, of course, you've been arranging already transaction. You have experience from coal to power projects. So can you tell us how you would normally de-risk these projects, especially at the early stages?
I'm not sure that de-risking the project is obviously for the benefit of someone. So obviously we have to look at de-risking it for the lenders and to some extent for the sponsors. But as we were discussing yesterday, trying to get the project to a position where not simply the investors and the financiers are happy, but also the off-taker is happy and the government is happy, is, I think, the real challenge. We closed the project you referred to. We closed the Mambacoris project last year in Zambia. And a big focus of that early on was to ensure that our off-taker, ZESCO, had a position where it could not simply have a desire to purchase the power, but also was able to put itself in a position where it could afford that power. And so a lot of focus was on where ZESCO were going to sell the power, at what price they were going to sell the power. And they were very open about that, and that helped to bring the project together, and it was a very key part throughout that process. Even then, it took a long time to close the project from the outset, and negotiating things like the PPA were the least difficult part of the project in the end. It still took a long time. And really, probably, the main reason why it takes such a long time is because very often we're dealing with firsts in projects, and we don't often get to the situation where we're repeating that deal or we're doing another deal, which is exactly the same as the one we did previously. Until we get to a position where we're doing that, when everyone sort of understands the risks on both sides of the table, until we get to that position, we're not going to get all these projects closed that we want to get closed. But we have to start somewhere, and the truth is that in terms of de-risking for lenders, there are so many sort of different ways in which we can do that. And again, that didn't prove to be a particular problem for us because there are many projects. Even though we had a coal-fired project which took out probably about 80% of potential investors and potential lenders, we still were able to raise finance. We raised about $515 million initially, and then we added another $75 million after financial close. So actually raising the money there was not the issue once people were comfortable with the way in which the project was structured. So the way in which we tend to look at the risk for each project, though, tends to be on a project-by-project basis. And so we tend to look at each project and say, well, how can we solve the particular problems of that project? It is going to be a lot easier if the utilities in each country are structured in a way that enables them to finance sensibly all of their power needs and all of their power projects. And that is a challenge, not just for the utility, but also for the governments. Because I think governments tend to say to utilities, well, look, restructure yourself in this way, behave like a commercial organization, but then don't necessarily follow through and allow that utility to behave like a commercial organization and to set the tariffs at the levels which mean that it can afford to purchase the power and can afford the power developments that we want to work on. So until that sort of political will is there as well, I think there's always going to be that struggle.
Thanks very much, Nigel. And now it gives me opportunity to open up the floor for questions to the panel. And please raise your hand if you have a question and introduce yourselves. And who are you asking the question to? Any questions from the floor? No? Maybe I can start off the questions. Almasu, well, I see that the role of PDA Bank has invariably become much more commercial. I mean, and you're moving away now from the traditional DFI role to a more commercial role. What do you think it takes now to mobilize additional funds in order to be able, from the private sector into PDA, in order to be able to catalyze these institutional investors to come and invest in infrastructure in Africa?
Well, maybe the first thing to say is the founders of the bank, when they first set it up, they were very clear in not setting it up as a conventional DFI because those already existed. It would have been duplication. You have the African Development Bank, clearly the global ones as well. So it's not really a change. We've always had commercial principles as being in our constitution. I think what just happened is the bank matured and found a way now to start operating effectively as a commercially oriented entity and to do so very profitably. It's not easy to become a profitable institution overnight. There were teething years, 10, 15 years, teething years to get the machine going. So that's the history of it. I think in terms of mobilizing capital, our first effort to mobilize was actually to look at the debt world. And I think it's been quite a story, not just PDA Bank, but I think the continent as a whole has managed to tap Eurobonds as a specific form of debt capital in a massive way over the past 8 or so years. We sometimes forget that at the turn of the millennium, there was no market at all for African bonds. You know, when we talk about platforms, we have private equity funds, but then there's also bond markets, right? And when you look at the number of bonds that African countries have issued, including infrastructure bonds, it's actually quite distinct from the history of the region. I think you now have an environment where there's so many listed African paper, of course by sovereigns. Some of them are dedicated specifically to infrastructure. So we've actually gone through the same experience. We had our debut issue in 2010, and then we've had one other issue after that. In fact, one of our bonds was 5 years, and we paid it off fully in January this year. And when you look at the indices in Luxembourg and you look at how Eurobonds are trading in this past quarter, we all know Q1 in 2016 was one of the worst quarters that the banking and financial sector has seen in the past 7, 8 years since the financial crisis. And you know, you see that some of these Eurobonds from Africa are still performing very well. We're performing above par still today, despite the discounts that you see on many of the others, some going down as far as 38, 40% discounts from the issue date. So there's been a lot of volatility and movement, but that alone tells you there's been sea change. Mobilizing capital is, the sovereigns themselves are doing it in a huge way. Of course, the experiences differ, and the pricing, of course, swings depending on the mood and the perceptions. We've had a lot of downgrades in the past year or two, and of course that has helped to generate those discounts on those bonds. So I think the bond environment has been one specific space. The equity one is a little bit less, how can I say, we've seen less traction with sovereigns themselves raising it. We don't see any infrastructure bonds by way of project bonds, for instance. Those hardly are out there. So you see basically blended bonds or asset-wide, infrastructure-wide bonds. I think the issue is now, there is a lot of interest in Africa, but the problem is getting through the funnel. Everybody at a high level is very interested in getting exposure. People rush to the continent, they get onto the ground, and then they realize that, how do you actually make that a reality at a deal level flow? And you have a lot of competition at specific deal level. So once a deal looks like it's bankable, it's like, for lack of a better image, it's like vultures on on a carcass in the middle of a desert almost, So it's it's the discussions that this forum has been having yesterday. How do you unlock the potential, get that upstream picture clear, get more resourcing upstream, and of course trying to get the framework to make it possible for those upstream interventions to get movement. So mobilization, I think we're no longer at the old story of saying, come to Africa, come to Africa. I think people are interested. There's a lot of interest in Africa. Our own African institutional investors, many African institutions have a lot of money parked overseas, including central banks, pension funds, and some of these are not even equity investments. Many of these are sitting in bank accounts, sitting idle. Of course, there's requirements as to how much of it you can place in tied long-term investments, but there is a lot of interest even with Africans, and I think really it's a question of operational capability, and I think countries, governments need to also take advantage of this environment, because you have some governments that are very aggressive on reforming still today. So if you're able to convince the world, including African investors, that you're a government that's going to do everything within your power to fix those things that are intrinsic to your country, then I think there can be more mobilization. So I think the international accords, like the Financing for Development Summit that took place, we have all these very strong thrusts from the global level to enable that resourcing to happen. I think we need to always reward those who are really proving that they're preparing the ground for that investment. And I think this is where we also need to open our eyes and listen and make sure we take those risks in those geographies, in those countries where we see real commitment to working with the rest of us. So I think that's my view.
Okay, thanks very much for that, Matsu. Are there any further questions before I wrap up? Because we have already reached time, and I think it's time to wrap up. If there are no burning questions, I'd just like to finalize. I mean, we talked about the challenges faced by the current infrastructure for institutional investors in investing in the infrastructure market in Africa. We talked about the regulatory environment, the Basel III requirements, which are very stringent, the upward pricing structure, macroeconomic factors which impact the devaluation of the currencies. Obviously, nobody likes to see the currency devalued. Political risks involved by institutional investors investing into Africa. Construction risk also being linked to the phase, the implementation phase of the project. But also we've seen some positive remarks from the panel. If you look at the past 20 years, it's been a lot of reforms, and we talked about the advantages of the telecom sector really picking up in Africa, and now we're hoping that the same will follow for the energy sector. And the reforms in terms of the African states being among the top 10 reformist countries in the world, which is very positive. We've seen a lot of emergence of private equity funds, sovereign bonds being issued, and infrastructure funds coming up. I think Kenya was particularly successful in doing that. And the financing of projects generally, it's not about lack of funds, it's also about bankable projects. So that's what really drives the investment into these kind of projects. It's never about the funds not being available. The funds are there, but the projects have to be bankable. And I hope you join me in thanking our panel, all our colleagues from Chris, Terence, Mark, Anmasu, and Nigel. Thanks very much for being on this panel, and please join me with thanking them for being here.
Doing business in Africa. You can't afford to be without Africa Investor.